It's time for the big three stocks, three charts, and three trades. I'm Jenny Horne, joined now by Tom White, of course, the co-host of Fast Market. We're starting off with one of our favorite names to discuss here on the network, a frequent flyer, if you will. That's Tesla, which is now up 22% still for the month of December. But I will say, seeing some weakness to start off this week, now has pulled back about 13.5%, 14% almost actually from its highs of the year. So I know this was a post-Trump election winner. We're starting to see some of this easing, though, as I think historically right now volumes are light. We're just not seeing a lot of interest flow into Tesla.
There's a lot of volumes, but there's less interest because it's not going up as much as it was.
Right.
I think
my bias is getting in the way there.
Right. I mean, with the stock up nearly 70% this year, as you mentioned, 22% just this month. Remember, that's after gains of about 38% that we saw in the month of November on the back of that Trump win. All the expectations are that regulations for Musk and Tesla with their cyber taxi, cyber cab, that's supposed to roll out sometime later in 2025, maybe into 2026. So expectations are high, but you see the parabolic move that we saw the last couple of months here. Now the stock's down over $65 from those all-time highs of about 488 that we hit earlier this month. So it has pulled back some. Now, what are the catalysts moving forward for Tesla, Jenny? Is, well, one's January 2nd. We're going to have Q4 reporting on deliveries. Expectations around the consensus about 512,000 vehicles at this point. Some people are still saying, that this could come in a little bit lighter as the EV trades kind of taking a break here. It's going to probably be in line with deliveries of last year, which was 1.8 million. So this is going to be a big catalyst on January 2nd. Implied volatility levels in Tesla, even with the parabolic move to the upside, the IV percentile ranks about 80%. So it's basically in the top 1/5 of implied volatility levels that we've seen over the last 52 weeks. And that's not surprising with that January 2nd deliveries date. UBS did come out with a note over the weekend on Tesla. They've still got a sell rating, $226 price target. Their expectations are for about 510,000 deliveries announced on the 2nd of January. So lots going on here. They report earnings on the 21st also, or 29th, I believe. Also, so there's going to be some more catalyst moving into the end of January on the earnings data that we get also. So I looked at a strategy that takes advantage of that high implied volatility levels. We've seen the stock pull back. Maybe it doesn't go up anymore. Maybe it starts to consolidate here. And the strategy I came up with takes advantage of a neutral to bearish type of stance with good risk reward setup because you can profit in 3 out of 4 different scenarios. So let's walk through the trade first here, Jenny. Out in the January 3rd weekly cycle, so you're going to capture those numbers that come out on the 2nd. So that's why implied volatility levels are elevated. I want to take advantage of that. So I looked at going out to the January 3rd. They expire in just 4 days. You're going to capture that event. Sell the 435 strike call, and then against it because I want to stay risk defined. We all know that Tesla can move parabolic in either direction. Buy the 445 strike call against it. So sell the 435 call, buy the 445 call, short $10 wide, neutral to bearish. Call vertical, collecting roughly about $2.50 credit. That's what you can make on this position, $250 with $750 in risk. But it takes your break even up to 437.50 to the upside. That's over 3.5% above the current share price in Tesla. Probability of that short 435 strike call being out of the money at expiration, which is what you want. You want it to be below 435. That's about 68% probability of finishing out of the money. So that is that higher probability of success on this neutral to bearish stance. I mentioned you profit in 3 out of 4 scenarios. If the stock goes lower, you keep the credit you collected. Stays where it is, you keep the credit. Or it even goes higher, but remains below that 437.50 break-even point. You can remain profitable on this really short-term positioning, trying to take advantage of that higher implied volatility level. Now, if you're more bullish on this name, maybe you sell an out-of-the-money put vertical if you think the stock's going to go higher by Friday after those delivery numbers on the 2nd. So this is the neutral to bearish type of stance where you're giving yourself a cushion to the upside and better probabilities. But if you're more bullish on it, just flip-flop it and sell an out-of-the-money put vertical. But This is just an example of what you can do with the expectations that the stock's not going to go much higher.
And I think good breakdown on some of these timelines that have like catalysts we have to watch, of course, for Tesla, because I do feel like 2024 has stuck up on us closing here. Now we have all these dates and events to look forward to in the new year, of course, which it's wild how fast this past month has gone. Nvidia, though, to shift gears here and look at a name that's actually moving positive in a sea of red, especially for the tech names. Actually, this is our only tech name that's currently still in green territory, modestly so. Nvidia is up 0.6%, our third best performer in the S&P 500 to close out this year. Walk us through what you're seeing here with Nvidia.
Not surprising. We've seen this trade over the last month or so when a lot of the Mag 7 names were hitting all-time highs, and Nvidia is still down 10% off its all-time highs from the end of November. So it's still in correction territory at this point, but now we're seeing a little bit of pullback in a lot of those Mag 7 names, and Nvidia getting a little bit of a boost. I think one of the catalysts, and maybe why, we're seeing some unusual option activity in there on the call side in Nvidia also, is January 6th at the CES conference in Vegas that Jensen Huang is going to give a keynote address. January 6th. Mark that down in your calendars as a potential big catalyst for Nvidia. Jensen Huang's usually pretty upbeat and talking about demand for the Blackwell chip and then their Hopper chips also, which are basically sold out at this point. What will he say? What type of demand will we see? Because we have seen that pullback from all-time highs. The stock's still up 178% this year, Jenny, so it's had a good run, even though it's off 10% from those highs that we saw. Also, some news today that ByteDance, they were going to try to buy up to $7 billion worth of NVIDIA chips outside of China. Remember, there's those restrictions that these Chinese companies cannot buy the high-end NVIDIA chips. So that was maybe a positive causing the stock to go up here a little bit. But I looked at a strategy that takes advantage of capturing that, that CES keynote that Jensen Huang is going to deliver. I went out to the January 10th month or weekly cycle. That's about 11 days to expiration. You're going to capture that, that talk from Jensen Huang, where I'm going to buy something but offset some of my costs. It's a bullish trade, but it's a vertical. I'm not buying just a straight call. I'm buying a vertical to offset some of my costs and risk on this bullish trade. January 10th, buy the 137 strike call. It's basically at the money. It's got the higher delta. It reacts more like the stock. And then against it, sell the 147 call. So a bullish $10 wide call vertical to the upside that takes advantage of a move higher. If you pay on this $10 wide bullish call vertical, you paid about a $3.80 debit. There's your risk, $380. That can expand to $10 if the stock goes above 147 over the next week and a half here. Your break even on this one where you start profiting at expiration, $140.80. That's only about 2% above the current share price. So you don't need a monster move to the upside. Now, why not just buy the 137 strike call it a bullish trade? Well, you're going to pay more for it, right? You're offsetting some of your initial risks on this with the expectation that, hey, it can go up. I just don't think it's going to go up maybe more than 147 over the next 11 days. This is really short-term positioning, but you're taking advantage of that potential catalyst to the upside here in NVIDIA if you think this thing's going to rally after Jensen Huang speaks. And remember, this has been the underperformer in the Mag 7 over the last month. If it starts to perform well, the market goes up, NVIDIA is probably going to participate there, and you can take advantage of that.
It has, and I think a good point, because I know that chips for so long held up, it felt like the overall market, but that has not been the case in the back half of this year. And I think NVIDIA, some of the sort of range-bound activity has been unusual, especially for a name that still, to Tom's point, is up 178% on the year. Last name today, though, of our big three is Netflix, which is up 85% to close out 2024, at least as of right now. Also has pulled back about 4% from its high, although I will say that of these three names, it's at least the closest to its high of the group. But again, seeing a modest pullback, slightly lower today. I will say that they have done a few things right as of late. Whether I want to endorse Squid Game or not, I cannot deny the fact that more and more people are talking about the platform than ever before, having successful NFL games on Christmas. I mean, everything seems to be working right now for Netflix. Yeah,
that push into live programming, live sports, I think is going to be a big catalyst for them. But is it already built into the stock? That's one thing that is a concern, I think, for a lot of investors. The stock's up over 80%. so far in 2024 going into the end of the year. But it's off about $50 from its all-time highs in early December. They got earnings on the 21st of January, so that could be a potential catalyst moving forward. You mentioned the NFL games. They averaged about 24 million per game, they stated. I'm hearing rumblings about 65 million in total, at least tuned in to a part of it. You mentioned Squid Games. That's getting good reviews at this point. Does that produce more people subscribing to the product at this point? But a lot of people have, price targets over $1,000. They're trying to ride this winter into the end of the year. UBS did come out with a note and said, hey, this live programming, where it worked out well for them. They didn't have buffering issues like they did during the Tyson-Paul fight in November. So that's a positive moving forward. And I think maybe some of the network channels should be scared moving into 2025 and later. But let's get to the trade here. Now, this one is neutral to bullish on Netflix. It's got a good base in, if you look at the chart on it, of about 885 over the last few weeks. That's been a good bottoming point for the stock, around 885. So I looked at a neutral to bullish short put vertical that's out of the money to the downside. In the January 17th monthly cycle, so you're going to avoid that earnings on the 21st. I think that's really key. Sell the 875 strike put, and then against it, buy the 855 strike put. So a short, neutral to bullish, $20 wide put vertical that you're collecting roughly about a $5 credit on it. That's what you can make. You can see here from the risk profile, I can collect $5. That's going to be my max profit, $500. My break even on this now, because I sold the 875 put, you subtract the $5 that you collected, your break even is about $870 over the next 18 days. That's about 3%, just over 3% below the current share price. So in this strategy, you profit in 3 out of 4 scenarios. If the stock goes higher, you keep the credit. Stock stays where it is, you keep the credit. Stock goes lower but remains above the break even of $870 is going to be profit on this type of trade. The probability that that short 875 strike that you sold in this position is out of the money at expiration is about 65%. So you've got that higher probability of success. Now, what's my risk on it? About $1,500 per spread, and that's below $855. So you've got a big cushion to the downside before you get max loss. But with these high price names and the ability for these stocks to move pretty significantly over a specific amount of time, I like doing short verticals as opposed to naked options where I just sell the 875 put. Still risk defined on this one, but your break even, as I mentioned, over 3% below the current share price.
Okay, and good breakdown on Netflix. I also did want to note that WWE's Monday Night Raw will be coming January 6th, which I will not be a viewer of. I doubt you will be either, but it is something that draws in a huge fan base. So
it does.
Continuing to draw in more and more eyeballs on Netflix, I think, is huge. But thank you so much, Tom, for those trades on Tesla, Nvidia, and of course, Netflix. This has been the Big Three. Keep it locked to Schwab Network for even more market content.